what's going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and in today's video, we're going to give you a quick update on where mortgage rates are, and then we're going to take a look at how that movement has impacted your purchasing power. And before we get into it, if I could ask a small favor, please smash that like button. It really helps grow and promote the channel. Let's go. So I'm going to go ahead and share my screen, and we're going to take a look at where the 10-year Treasury yield is. For those of you who don't know, the mortgage rates tend to follow the 10-year Treasury yield in nearly lockstep fashion, meaning if the yield goes up, mortgage rates rise with it. If the yield goes down, mortgage rates generally fall. And so up on the screen, I have the 10-year Treasury yield. You can find this on CNBC or any other major news site, and I have a 1-month chart. So today we're currently sitting at 1.765, but over the last month, you can see that it's gone up fairly dramatically here. We saw lows at about 1.4%, and now we're up nearly at 1.8. So the 10-year Treasury yield has gone up, and mortgage rates have gone up alongside of it. But let's go ahead and take a look at that now. So this is the average mortgage rates from Freddie Mac directly. I'll go ahead and link to this website in the show notes below, and it's updated as of yesterday, which is January 13th, 2022. It shows us the 30-year fixed, the 15-year, and a 5-year adjustable rate mortgage. So let's take a look at where we are. So 30-year fixed is sitting at 3.45% on average, and that comes along with 0.7% in points. So what does that point structure mean? That is a percentage based on the loan amount. So I'll go ahead and pull up the calculator here. We can take a look at what that means. Let's say you have a $300,000 loan amount. You would multiply that by 0.7%, and it would give you $2,100 in points. That is what it essentially costs in order to secure that rate. Now, this, of course, is just the average fee structure. You'll want to, of course, talk to your mortgage professional or your mortgage broker and go through the different options for you, but that is what they are seeing across the board on average. Now, 15-year fixed mortgage is hovering at 2.6% with the same 0.7% fee structure, and then a 5-year adjustable rate mortgage is sitting at 2.57% with 0.3% in points. Now, a couple things that I want to point out. Let's look at this chart here. So the average 30-year fixed rate as of this week is sitting at about 3.45%. Look where we were just a few weeks ago. We were sitting at about 3% on average. So we're up nearly 0.5% with regards to rates. And this is referring to a primary residence, generally with 20% down or 20% equity in the property. So the question is, why are these rates going up? Well, we have government reported CPI at 7%. So my thought is that the market is trying to price in inflation. So inflation runs hot, generally these rates rise. And then of course the Fed has come out saying that they intend to raise the short-term interest rates here moving forward at the next Fed meeting. So I think the market is trying to price all of this in. It's causing interest rates to go up. All right, so how does the rising interest rates actually impact your monthly payment? It's important to illustrate this and take a look at an example, because even with the 0.5% move up in rates roughly, we are still at historic lows. So let's run a quick example here. We'll take a $300,000 loan amount at 3%, which gives us a monthly principal and interest payment of $1,265. That was the average interest rate a few weeks ago. If we bump it up to 3.45%, which is the average rate today, it bumps the payment up to $1,339. So it went from $1,265 to $1,339. That's about a $74 per month difference. All right, so there you have it. Mortgage rates are on the move. They're up about 0.5% from where they were a few weeks ago. On a $300,000 loan amount, it's impacting the payment by about $74 per month. This, of course, is putting some pressure on affordability. However, we're still seeing mortgage rates at all-time record lows. If you kind of zoom out and take more of a macro view, 3.5% on a mortgage, especially on a 30-year fixed rate mortgage, is still insanely low. And of course, when you combine record low mortgage rates with record low amounts of inventory and super high buyer demand, people are still lining up to purchase property, even with the increase in mortgage rates. Now, it seems as though the market is trying to price in this inflation and future Fed rate hikes. The question is will the mortgage rates continue to rise, and will it continue to put some downward pressure on affordability? We will continue to monitor the market. We'll continue to do these updates for you, and let's see how the next few months unfolds. Thank you so much for taking the time to watch this video. Please leave your comments below, and if you haven't done so already, please consider liking and subscribing to see more videos like this on a weekly basis. Take care.